BlackRock has just come out and released their 2025 mid-year outlook. Now in this video, I'm going to break down exactly what they're saying here, because what this amounts to is basically their plan for the next year on how they're going to turn their business around and try and take over the world or continue doing it. I'll cover everything, explain exactly what's going on, and then I'll also explain what they don't want you to know about this mid-year outlook as well, and why they're saying some of these things, because as always with someone like BlackRock, there is a huge agenda at play here. Now, why does this matter? Well, BlackRock now have almost 13 trillion US dollars in assets under management. That's about the same size as the Chinese economy. It's bigger than every single country in the world except for the United States and China. And they've had this massive public relations collapse over the last couple of years as people, ordinary people, thanks to new media and YouTube and Twitter and things like this, ordinary people have realized exactly what BlackRock are doing. This document is basically their plan on how they're going to continue dominating the world, on how they plan to continue growing their assets under management by a ridiculous degree, and how they're going to use their influence to push our economies and our democracies in a direction that helps them make money. Now, the first really important thing about this entire document here is that uncertainty is absolutely everything, and it's 100% key to BlackRock's plan. They're kind of saying out and open here that they don't really know what's going to happen next. We've seen 3 separate market crashes in 2025 so far, with the April market crash being the biggest one we've seen since the COVID crash, so not a small fry by any means. But all of these crashes have been from macro factors, tariffs and trade wars, and basically Trump's policy objectives. And despite that, the market is still sitting at all-time highs as we get to the midpoint of 2025, despite those 3 crashes, including a massive April crash. And what BlackRock are admitting openly here is that they cannot predict the future, but they're still going to try a little bit. Now, usually, typically, when it comes to these massive institutions like BlackRock, they would feel a lot more comfortable predicting where the economy is going to go, or where a certain sector or industry or commodity price is going to go 5 or 10 years into the future, because it's less volatile and it's less reliant on things like Trump going out and putting some trade tariffs on China and then taking them back a couple months later. But BlackRock right now actually think the opposite is true. They have no idea what's going to happen 2 years, 5 years, or 10 years into the future, and so they're concentrating almost entirely on short-term plays. And you can see that here with the introduction to this document right here. Our 3 themes spell out the investment implications of this. Investing for the here and now. Basically, they don't want to be thinking years into the future because they are so afraid of getting it wildly wrong that all of their assumptions would be completely useless. Whereas over the next 6 months, they can make some pretty solid guesses in their mind as to what's going to happen and how they can profit from this. Now, what's causing all this uncertainty? Well, the biggest thing for sure is Trump's brand new big, beautiful bill, his new tax cuts. There has been loads and loads of uncertainty throughout all of 2025 thanks to Trump's bill, but that now is finally more clear. We weren't sure if the bill was going to be passed. We weren't sure, if things would be removed or things would be added, but now we know exactly what it's going to consist of. I made an entire 25-minute video breaking down exactly what it is and the tax implications, and are you going to be better off or worse off if you are interested. There'll be a link down below in the description for that. But BlackRock are definitely still scared of the long-term implications of this tax bill, in particular from the increasing deficit, from the increasing cost of debt for that deficit, and then from increasing inflation from that bill. That's the big fears they're seeing from the big, beautiful bill, and they really aren't sure how it's going to play out, which is why they aren't predicting 2, 3, 5 years into the future. They're only looking at the next 6 months, where something like this tax bill doesn't really have time to make any huge changes. The next really important driver of uncertainty in the markets that we've seen this year so far have been tariffs. And BlackRock basically think that actually the tariff chaos with the markets is over. Now, there were 3 big tariff moves by Trump in the first 6 months, and the third was the one that caused that biggest crash, the April market crash, the biggest one we've seen since COVID. But for some reason now, BlackRock are basically stating that they think the tariff wars are over. Now, in my opinion, that is absolutely delusional, and just as one example, we can see that even Bloomberg is very unhappy and uncertain about what's going to happen with tariffs going forward. There is a sort of loose deal in place between the EU and the United States at the moment while they're negotiating, trying to put together a permanent deal on trade and with tariffs. And the deadline for this is the 1st of August. Now, if that isn't met, if they don't manage to find a deal by the 1st of August, almost all EU exports to the United States will have a base 30% tariff, which is huge. Cars and auto parts would get an extra 25% tariff, and for Europe and Germany in particular, that is a massive hit because they export a hell of a lot of cars and auto parts to the United States. And then steel, aluminium and copper get an extra 50% tariff on top. That's almost $500 billion worth of trade having as much as 80% tariffs chucked on top of it every single year. And of course, that's not including the retaliation tariffs that the EU would certainly put on the United States themselves if this deal is not met. Now, even if the deal is met, well, Trump is looking and seeking for a permanent 10% tariff on all EU exports, plus extras on other certain industries, and then protections against digital taxes on revenue for US tech giants. What we've been seeing over recent months is the EU basically trying to take some of the tech pie away from the United States by taxing companies like Google and Meta based on the revenue they generate within the EU, as opposed to the profit, which is always offshore to a third-party country like Ireland. Trump and the United States and these tech giants as a whole are really, really unhappy about that. They see this as an unfair, illegal tax on a company which just isn't European, and they should have no right to do that. And so Trump's seeking for protections against this as well, basically treating that as a tariff against American tech companies. So it's looking unlikely that the EU and the United States are going to agree a deal in turn, which means that we're going to get this escalation of tariffs between the two countries. And we actually have the exact same thing going on with China right now under incredibly similar circumstances. There is also this sort of loose ceasefire in the trade war between China and the United States right now. It also has a deadline of the 1st of August, which is just about a week away from today. And again, if it isn't met, we're going to see massive, massive tariffs thrown onto the Chinese economy, and then China throwing massive tariffs back onto the American economy as well. It's also worth noting that Trump has shown repeated willingness to U-turn even after a deal is struck when it comes to trade and tariffs, and then to renegotiate to get better terms, which is why we had 3 separate market crashes and not just one big market crash when Trump announced one whole tranche of tariffs. He is well aware that he holds all the cards in these negotiations, and so every time he negotiates, the United States is going to come off better off than these other countries, so he's willing to go back to the negotiating table. And so BlackRock sitting out there and saying that there's no more tariff chaos to come, I think this is absolutely delusional. I think we're going to see within a week just how delusional it is, and we should never expect Trump to be happy with the deal that's been signed. He's always going to be looking to push it further, to renegotiate and to get better terms. Now, the next really important thing to talk about, and what BlackRock is sort of sounding the alarm about, is losing long-term macro anchors, as you can see right here. Basically, what are macro anchors? Well, they're essentially traditional rules of thumb that were trusted to just keep economies and global markets consistent and reliable. Things like inflation should sit at around about 2%, which means sometimes it's going to be a little bit lower at 1.5, sometimes it's going to be a little bit higher at 2.5. But it's not really going to stray into that 3% or 4% range. BlackRock is saying that these traditional macro long-term anchors which hold the global economy together are disappearing and they don't really exist anymore, and they've called out a bunch of them specifically as well. So that first one of inflation, the traditional inflation target being 2%, that's no longer the case according to BlackRock. They think that countries are going to target 3% inflation from now on. And again, this is not just about the United States. The US is currently sitting at about 2.7% inflation, up from around 2%, which was the average about 10 years ago. Germany is at 2%, up from an average of 1.5% 10 years ago. The UK is at 3.6%, up from an average of about 2% 10 years ago. And Japan's inflation is at 3%, up from an average of 0.5% about 10 years ago. So everywhere we look, when we're looking at these most important economies around the world, they are seeing massive levels of inflation that are far, far higher than what we would have traditionally expected, and that macro anchor of 2% steady, stable inflation is just not existing anymore. The next big macro anchor that's disappearing is fiscal discipline. Basically, governments are spending more money, they're taking out more debt, and they're not increasing taxes by as much as they're increasing their spending. And this aligns with higher inflation, as the inflation is basically a stealth tax to make up for that deficit. Again, this isn't just the United States we're seeing this happening. A $1.5 trillion per year deficit right now is what the States are seeing, up from $500 billion about 10 years ago, so it's tripled. The German deficit is at 3% when they had a 1% surplus 10 years ago. The UK deficit is at 5% right now when it was 2% 10 years ago. Canada is at 1.7%, up from 1% 10 years ago. Basically, BlackRock states, and I fully agree with this myself, the Western governments and their solvency cannot be counted on anymore. They have lost fiscal discipline, and they aren't going to be that bastion of stability which helps the global economy grow anymore. Alongside that comes yields on government debt. Again, that era of super cheap government debt that we've seen for about 2 decades up until COVID came, or a couple years after COVID. That's over. US Treasuries at 4.5%, up from between 2 and 3. UK gilt yields are at 4.5%, up from around 1% 10 years ago. Japan at 1.5%, up from 0% or even negative yields about 10 years ago. And again, this is the same across most countries around the world. Next then, we have the safe haven status of US assets. Now, BlackRock have been a little bit cautious here. They are still saying that the US is the gold standard for assets, in particular companies like the Magnificent Seven, which drive the vast majority of growth in the S&P 500, but the rest of the S&P 500 as well. But the idea of it being a safe haven is eroding away. Basically, geopolitical risk that is increasing when it comes to investing in the United States as a foreigner because of things like tariffs and sanctions and de-dollarization and inflation. Now, we're already seeing massively reduced inflow of foreign direct investment into the United States. The previous quarter was $67 billion in FDI. The year before, for 2024, that same quarter was $81 billion. So about a 15 to 20% drop we're seeing across the board on foreign direct investment over the last year alone. But most importantly of all, is of course that US Treasuries are seeing far less demand from foreign investors, which is how the United States has been able to finance their massive deficit for so long now. Now, the final macro anchor that we're losing is central bank independence, but I think that we should chuck onto that because BlackRock aren't talking about it, but also central bank reliability. It isn't just their independence that's a threat here, it's their reliability and their effectiveness as well. Now, monetary policy is of course more important right now than ever before, and there's been a mass loss in trust in central banks after COVID and inflation because they behaved so abhorrently and really destroyed our countries. And again, this is not just in the States, this is all over the world. There's also, though, been loss in trust of government organizations like the Congressional Budget Office in the United States, but then equivalent offices in Europe and the United Kingdom as well, so this isn't just the US. And along with this comes Trump's direct attempt to force these supposedly independent organizations to move things into his terms. In his specific case, he is desperate for Jerome Powell to lower interest rates, to slash those rates, to get the economy moving, despite the significant risk of inflation that the States is currently seeing. Trump has taken that a step further in recent weeks as well. He's been actively threatening to fire Powell and to put someone else in place who will lower interest rates for him. So this is obviously damaging the independence of these central banks. But more importantly than that, the central banks, they just don't have the legitimacy to be making these far-ranging, really impactful decisions for the entire country after they failed so, spectacularly and so publicly over the last 5 years to rein in inflation. And they massively overreacted to COVID and caused us huge amounts of turmoil. So they are losing that independence, but they've also lost any legitimacy they have to say that they know what's best. So a lot of people are supporting them losing their independence. Now, all of these here are basically rules that held true and ensured global economic stability and, the line go up mentality. First world governments were responsible and they had a close to 0% chance of financial collapse. Inflation was low, which ensured that consumers were confident in the economy. They knew how much their rent was going to be next year and how much eggs were going to cost next month. And that meant the economy was strong and people would invest and build businesses and invest into themselves and it would grow. That's disappearing too. Government debt was cheap, so deficits weren't actually so worrisome and they wouldn't spiral out of control, but that's changed. The debt is no longer cheap and the deficits are getting larger. And then these American assets were always the gold standard for investment in terms of risk and the threat of some kind of political encroachment upon investments, but also in terms of just the outright returns you could be getting. And then, of course, we have those central banks and those government organizations which could be trusted to be smart and to make the right decisions, but also impartial. That's gone too. And BlackRock is really, really clear here. They think that this is going to be absolutely disastrous for the global economy, and they have no idea how it's going to play out over the next 10 years, but they have zero confidence in their ability to say that the line will continue to go up. Alongside that, we have a few other problems as well. We have geopolitical shifts and de-dollarization. Basically, globalism is on the way out. Free trade is not the aim or the standard that every country is looking to pursue anymore, and protectionism is back. We've seen this sort of erupt as a result of a few different things. Firstly, we have these massive globalist institutions acting directly against the interests of the people who they're essentially trying to run from their shadow governments. But we've also seen the exposedness and how dangerous it is to have these incredibly long supply chains that work with countries which are literally our abject enemies. That's not actually an advantage, it's a weakness, and people are finally seeing it as that. So supply chains are being consolidated and brought back home as well. And then we have that de-dollarization effect. The dollar is under attack a little bit internally in terms of inflation and the loss of stability that the dollar had. I think the dollar index is down by about 10% over 2025 so far, so not a great performance. But also it's under attack from other countries, mostly BRICS nations, Brazil, Russia, India, China, and South Africa. But in reality, we're talking more about Saudi Arabia and the Arab states more than Brazil or South Africa in this sense when we're talking about BRICS these days. Basically, BlackRock is fearful that they can't rely on an American-controlled financial system anymore as leverage to boost the American economy, but also to hold the global, Pax Americana in flux as well. BlackRock did explicitly state that this is a long-term trend that we should see over the next 2 to 3 decades and not something we're going to see over a couple of years. And again, I 100% agree with that. But to surmise this entire report here, basically, BlackRock has no idea where the global economy is heading 3 years into the future, and they're right now just focusing on the here and the now over the next 6 months, making short-term plays based on industries and sectors. And that does lead us on quite nicely into the opportunity that BlackRock is talking about and where they want you to put their money, and in particular, how they want to take your money off you and put it into their pockets instead. So investing in the here and now, I've split this up into 2 separate parts here. The first is going to be fixed income, so bonds. And basically, BlackRock thinks that US bonds are worse than European bonds right now. The federal deficit is so ridiculously large that it simply cannot be paid off from tax revenue, and it means that the only reasonable way it's going to be reduced is through inflation away of that debt. That expected inflation means that investor demand is much higher yielding. They require higher yields from the treasuries they're buying, which means there's actually less demand. Sorry if that's a little bit of a roundabout way to say that, but values of US treasuries are going to decrease as yields increase because of the expected inflation that's coming. BlackRock is also seeing a little bit more fiscal responsibility in European governments. I don't see that at all. I think they're actually in a far worse state than the American government. Yes, their deficits aren't quite as high on the whole, but the countries are just far poorer and have, practically no prospects of growth going forward either. So any deficit for them is absolutely critical. So they're recommending European bonds for fixed income investments as opposed to American ones. I don't think that's particularly smart, to be honest. European countries are not exactly solvent at this point in time. Next, though, we have risk on US equities. Basically, they are still bullish on the American market, just only for the next 6 months. They are expecting those stocks to rise, but they are expecting also a lot of policy shocks, right? We've had those 3 crashes already in 2025 because of Trump's tariffs. That wasn't because of data, suggesting that the tariffs were going to be really impactful. That was from the market panicking and overreacting in BlackRock's mind and mass selling. And I think that actually it's fair enough to say that the markets were overreacting for them because we're once again back up at all-time highs despite having massive crashes. BlackRock are pretty firm that they think the policy shocks are done and there aren't going to be any more crazy Trump announcements. Again, I think this is utter lunacy. How arrogant you have to be to believe that the person who's done the same thing month after month for 6 months in a row is suddenly going to stop because you want him to. The EU-USA trade deal deadline is in 1 week and there's no deal so far. The exact same is to be said for China. August 1st deadline, no deal either. We're likely to get policy shocks within a week of this product being released by BlackRock. So utter lunacy in my opinion. And we've also seen repeatedly Trump going back and throwing away old deals, going back to ask more. He's also actually used tariff policy as soft power to gain political goals like deportations, and it worked incredibly well for him. He did it against Canada, against Mexico, and against Colombia. So it's incredibly likely that he's going to continue to use tariffs as that sort of leveraging soft power to get other political goals in the future because it's been successful. Why wouldn't he do it again? What this means is that we're going to see inflation. And inflation is actually very good for asset prices, which is one of the reasons that BlackRock is still bullish on the American economy. And again, I agree with this entirely. Inflation helps asset prices in two ways usually. Firstly, it's just the increasing cost of everything, of course, but CPI and broader based inflation almost always raises faster than wages do. And that means more revenue for companies with a lower comparative rise in wage costs, which means higher earnings, higher valuations from a fundamental standpoint, and a real increase in the wealth and the value of these companies, not just people's perception of the value of publicly traded stocks. But of course, inflation also causes artificial increases in the values of assets, right? House prices will rise faster than rents will. Investors will gain wealth from that asset valuation, but the rent yields will actually go down in comparison. So this isn't an increase in real value or real wealth, it's an increase in people's perception of that value or their perception of that wealth instead. The dollar will buy fewer assets that will return fewer dividends and rents in the future as well. So this is sort of debatable whether or not it's good for investors because your explicit returns in terms of dividends or rents will actually go down in comparison to how much you're investing, but the valuation and the market value and what you can actually sell those assets for will go up. And that's the big line that people usually focus on. So they will feel a lot richer because the line goes up right up until there's a recession or a collapse and we see a return to, accurate valuations of these companies. We're also seeing that index fund investing is no longer really the gold standard here. There is a big lack of price discovery going on right now because there's so much index fund investing. There basically aren't enough people actually looking at the companies in the index funds they're buying. And they just buy the S&P 500 for the sake of it. And the money just gets funneled into it, regardless of whether or not those companies deserve the investment they're getting. And in particular, we see mass consolidation of the biggest winners in the S&P 500, the Magnificent Seven, who have exploded and are worth a ridiculous proportion of the global market right now. Now, because of the removal of those macro anchors as well, BlackRock isn't confident in the entire market or the entire economy growing. Instead, they want to be focusing on specific industries or specific sectors that they think will outperform the markets. And that brings us over to AI, which is that first big sector that they're talking about, taking stock of AI's phases, as you can see right here. Basically, BlackRock wants to invest in sectors that are embracing AI. Some of the ways they're doing this is really stupid, I have to say. They are literally analyzing how many mentions of AI are going on within shareholders' reports, and then they're indexing those mentions against different companies in the same sector and then different companies in different sectors as well. And then they're just going to buy stocks from sectors which have a lot of mention of AI. This is stupid for a number of reasons, but the biggest one is that these shareholder meetings, these shareholders' reports, they are literally designed just to try and bring capital in. And when you see a bubble like AI, we've seen them in the past of blockchain and crypto, you see companies just mentioning it all the time because they know that people see that and they get bullish, and so it drives more investment for their companies and it raises their share price. That's exactly what BlackRock are doing here. They're just taking people's words at face value and saying, oh, he said AI 20 times in his shareholders report. They must be really good at AI. Let's invest in this company. a little bit ridiculous in my opinion. What I do agree with BlackRock about is that most people, in particular consumers, massively underestimate the utility and the value and the savings and efficiency gains of AI. Most people, when they think of AI, and I was guilty of this myself until about a year ago, they think of Grok on X, right, where you just at Grok and ask it for some evidence and it'll go out and find it, or they think about ChatGPT, which really, for the most part, is used by people just asking questions that they can't be bothered to Google themselves. There isn't much to be gained in efficiencies or value from those sorts of utilizations of AI. But the way businesses are using AI is moving more and more towards these concepts of agents, which do have massive efficiency gains. And a brilliant example of this, I run an agency, a business where we help online coaches grow their businesses. We call Grow Coach. You can check us out on the link down below in the description if you're interested. But we used to pay graphic designers for Meta ads and YouTube ads, the little stationary pictures that you see all over the place. We used to make them, and we used to spend around about $5,000 a month paying graphic designers to make these manually a couple of years ago. Nowadays, we don't hire a single graphic designer. They were all contractors, but we don't work with any of them anymore. And we get the exact same quality that they used to produce within 1 hour, which used to take them 1 day. And we spend about $300 a month on the AI to do it for us. And we can make very, very minor changes to it really, really easily. So we've had, my business personally, we've had a massive advantage just from that one very small utilization of AI right there. And we're seeing this all over the place, in particular with digital businesses. So there are countless examples of AI making businesses incredibly efficient, literally everywhere. And BlackRock think that this is going to get insanely powerful. Those companies which hop on will massively outperform the broader market, I agree. But BlackRock's method for finding those companies which are trying to capitalize on this boom is just a little bit stupid, and it isn't going to play out, in my opinion. Now, that's essentially this entire report and what BlackRock are doing and what they're trying to get you to do as well. They don't want you to buy index funds anymore. They want you to buy their new AI ETF that's actively managed. And they want you to be really, really afraid about the state of the economy 5 years into the future and 10 years into the future. Again, so that you don't buy index funds, and they want you instead to focus on the here and now, the next 6 months, which require an actively managed fund to make the most out of. That's what they're trying to get you to do. But what's really important here is BlackRock's actual business model and how they make money. And it is basically through index investing, right? Low cost, low management funds that just track a large pool of assets, things like a global stock tracker or an S&P 500 stock tracker. That is the vast majority of their business. And about $10 trillion of their business, of their assets under management, is just in low cost tracker funds. That means that $13 trillion of assets under management, they only get about $20 billion a year in revenue from all of that money that they're managing. Whereas a company like Blackstone, they have $13 billion in revenue from just $1 trillion in assets under management. So BlackRock is desperately trying to move away from these passively managed funds because they just have very, very low cost to them. They aren't able to charge much in fees, and they're trying to move people over to their actively managed funds to increase the value of each dollar that they manage. That's how they're trying to grow their business here. Those low-cost tracker funds are a relatively new concept. They were really popularized in the 90s and started to see traction then. And by the mid-2000s, about 30% of all fund management in the world was index funds. Now it is 60%. And this has caused loads and loads of new entrants to the market, and fees and the revenues, the profits that you're able to generate from running these funds have been ground down ever lower because it's so competitive. And BlackRock has found itself in a situation where they're literally selling a commodity and they can only compete on price. That's just an awful product to be selling at this point. So that's BlackRock's absolute intention here. They're trying to scare people into abandoning index fund investing to trick them into thinking that active investing through BlackRock, through this new AI ETF they're going to be launching, is the only possible way you can make money over the next 6 months. And if you're thinking about just sticking your money in a tracker fund for 10 years and forgetting about it, well, don't do that, because they don't think the economy is going to grow over the next 10 years. This is all just a ploy by them to try and get you to move your money into their actively managed funds where they can take 2% fees every year instead of 0.01% or whatever their actual cost basis is. And this is all because BlackRock are facing massive, massive problems here. And this is exactly what they won't tell you. They have suffered a huge amount over the last couple of years thanks to new media bringing to attention how awful a company they are. They've had that huge ESG and DEI controversy that's massively damaged their brand over the last few years. And then Trump and right-wing politicians all over the world, in fact, actively hate BlackRock for this left-wing push. And so they're trying to reinvent themselves away from ESG and DEI. In particular, they have really been struggling on their retail and their fixed income cash flow products, right? Their AUM from retail investors, the actual amount of assets they're holding for retail investors, is falling now every single month. They're only growing in terms of the assets they're getting from institutions like pension funds, which are the ones that were happy to see this ESG and DEI nonsense go in the first place. And even then, they're struggling. That's damaging their share price. That's making them struggle as a company as a whole. And so getting their customers, their clients to switch to actively managed funds is absolutely essential for the company to sustain growth because their inflows are down and their investor confidence is suffering because of it. That should be pretty worrying to hear, to be honest, because they are manipulating their own public reports, just like those AI companies are, by just saying AI over and over again to try and drive a reaction and an action from you so that they can profit off of it. So I really, really implore you to keep everything you've heard here and everything you hear from BlackRock in particular, in mind that it may not be true, or actually it's incredibly likely not to be true. I mentioned earlier as well about my company Grow Coach, which helps online coaches and consultants grow their businesses online. If that is you, if you're interested, or if you're maybe wanting to become an online coach or an online consultant, if you're an expert, if you have some information that people might like to hear, I've got a free training video down below in the description that you can check out, which explains exactly how the industry works and how my business helps other people grow their businesses as well. So if you are interested, head on down below to the link in the description and you can check that out. And I'll see you all again soon.